When you think about it, derivatives are like the shadows of the financial world, lurking just out of sight, but always influencing the light that shines on the assets we think we understand. They're not the stars of the show, but they're the ones pulling the strings, weaving a web of complexity that can either protect us or ensnare us. It's fascinating, really, how something so abstract can hold such power over the tangible, the real. Let's start with futures. Imagine a farmer standing in a field looking at his crops. He knows he'll have a harvest in 6 months, but the market is volatile. Prices could soar or they could plummet. So he enters a futures contract, locking in a price today for the promise of a sale in the future. It's a gamble, sure, but it's a calculated one. He's hedging against the uncertainty, securing his livelihood against the whims of the market. But what happens if the price skyrockets? He's stuck selling at that predetermined price, while others reap the rewards of the rising market. It's a double-edged sword, this tool of certainty in an uncertain world. Then there are options, which add another layer of intrigue. Picture an investor eyeing a stock that's poised for growth but isn't quite ready to commit. With an option, they can buy the right to purchase that stock at a set price, but they're not obligated to do so. It's like standing at the edge of a diving board, peering into the water below. You can choose to leap or back away, but either way, you've paid for the privilege of choice. The beauty of options lies in their flexibility, but that flexibility comes at a cost. The premium paid for that right can be lost if the market doesn't move in the anticipated direction. It's a dance of risk and reward, where timing is everything. And then we have swaps, the quiet negotiators of the financial landscape. Two parties come together, exchanging cash flows, often to manage risks associated with interest rates or currency fluctuations. It's like a delicate balancing act, where one party's gain is another's loss, and yet they both walk away feeling like they've gained something. It's a sophisticated arrangement, often hidden from the public eye, but it's crucial for maintaining stability in a world that's anything but stable. Forwards are the unsung heroes too. They're like futures' less glamorous cousins, private agreements made between two parties, away from the prying eyes of the exchange. There's a certain intimacy in a forward contract, a handshake agreement that binds two parties in a shared risk. But with that intimacy comes the danger of default. If one party fails to deliver, the other is left holding the bag, and the trust that once existed can evaporate in an instant. Yet, despite their complexity and the risks they carry, derivatives can be incredibly valuable. They're tools for managing financial exposure, allowing investors to navigate the turbulent waters of the market with a semblance of control. They can enhance investment strategies, providing opportunities for profit that wouldn't exist otherwise. But it's a tightrope walk, balancing the potential for gain against the very real possibility of loss. In the end, derivatives are a reflection of our desire to predict and control the future, to tame the chaos of the market. They're a testament to our ingenuity and our willingness to take risks. But they also serve as a reminder that in the world of finance, nothing is ever truly certain. The shadows may dance around us, but it's up to us to decide how closely we want to engage with them, how much risk we're willing to embrace in pursuit of our goals. And that, my friend, is the essence of the financial game we all play.